Welcome back to Coffee with Krav. I hope everybody had a very nice Memorial Day weekend, even though out here in the East Coast, it was a bit of a washout. One thing I will say, though, it looks like we're getting back to a bit of normalcy. As I go into some of the stores and some of the places, it looks like, people are masking up. Some people are not masking up. Interesting, went to a local store and I was the only person with a mask on. I was actually looked at, hey, what's that mask thing doing on you? So it looks like things are coming back to some normalcy, and looking forward to a great summer, even though we had the washout. So I'm really looking forward to today's guest. Today we have Alicia Levine. She is the Chief Strategist and Managing Director at BNY Mellon Investment Management. She is one of the firm's most authoritative voices for market analysis and compelling investment outlook. Alicia provides frequent, insightful, and timely market commentary and is a go-to person for client-facing economic analysis and market strategy. Alicia is a regular on-the-record source, live broadcast commentator, and breaking news analyst for a variety of media outlets, including Associated Press, Barron's, Bloomberg, CNBC, CNN, Financial Times, Fox Business News, New York Times, Reuters, Wall Street Journal, Washington Post, Yahoo Finance. She's also been on the cover feature of Kiplinger annual Where to Invest issue. Alicia received her BA from Brown University, earned MA and PhD degrees from University of Chicago. In addition, she was awarded a pre-doctoral fellowship from Stanford University, a postdoctoral fellowship from Harvard University, and research fellowship from Hoover Institution. What? No Princeton? I mean, come on. You're dogging it here. You're dogging it here. What's going on? Unbelievable. I bow to you. I bring everybody here, Alicia Levine. So thank you so much for joining us here with Coffee with Krav. Appreciate it.
Thanks, Mark. I like to say, my father never went to college, and I always joke that I had to get degrees for both of us. So that is my family legacy. Well,
I think you did it for the next generation as well.
Yeah, they hate me. They hate me.
They did for 3 generations. Well, let's look backwards before we look forwards. 2020 was a really unique and volatile year. What do you think some of the best lessons that we learned from last year?
Look, that's such a great question. And I've been reflecting on this and really thinking, 2020 was the most incredible investment year that I've seen in this business. And I've been in the business over 20 years. And I did start during the dot-com boom. And that had its own excitement, believe me. Very nice to feel smart every single day when every stock went up. But I look, there are several lessons to learn here. And I think there are 2 big categories. The first is that the stock market in the United States is not the real economy. Right? I mean, I think it tripped up a lot of investors when we were in the depths of a pandemic. 55% of global GDP was shut down, dead. I mean, no one ever seen anything like it. It was actually kind of terrifying. And yet the market went up and the market bounced. And the sectors that worked and drove the market really were sectors that didn't have a lot to do with the real economy. So tech, for instance, and the stay-at-home plays, and the rapid digitization of bricks and mortar businesses that were able to pivot to the digital world was extraordinary. And it wasn't so irrational, actually, when you thought about it. There was a disconnect between the market and the real economy. And that was true, but it didn't mean that the market action was irrational. And I think that was a huge lesson. The S&P is not the real economy, right? The S&P is about 35% tech. We talk about those 5 large cap tech names at, 23, 24% right now, but overall it's 35%. And I think we're going to 50% in the next 10 years. So let's think of it that way. The second thing we learned is that policy can overwhelm whatever fundamentals you see in front of you in the next 3 to 6 months. And what do I mean by policy? I mean fiscal, the $2 trillion that came right out of the government very quickly, end of March, early April, supporting households, supporting real estate, supporting small businesses almost immediately, and of course the Fed. And the bounce off the bottom on March 23rd had everything to do with policy, and the Fed saying we will do whatever it takes. So 2 lessons: policy matters more than fundamentals, and the stock market in the US is not Main Street, and it is not the real economy. Those are the 2 really big lessons. And I'll do the third one. Don't time the market. Never try to time the market.
Yay.
If you time the market, you got to be right twice. And a lot of people were right once on the way down and never got back in. So that's the third lesson. Stay invested. Don't look every day.
I love that. I love that. Thank you for that third one, because that's what I've been preaching now for 30 years.
And you're right. And you're right. You're right. And I have, my 401k, that I get from my employers, I let it go. I don't touch it. And in a sense, it's a way to test this theory, and it works. It works. Don't touch it. Don't touch it.
Well, you mentioned on the first one that the biggest winners were tech-oriented stay-at-home companies. Do you think that these companies still have legs?
So
can they go much higher, at least this year and into next year?
So you really have to break it up. We started pivoting to the more value-oriented and cyclical sectors in the autumn of last year, because it was very clear we were not going to be sitting in our living rooms forever, although I am still sitting, obviously, in my living room. Welcome to my living room. It does feel like forever. It's not always awesome, but it seemed clear that we were going to get to the other side of it. And, when COVID cases in certain parts of the country were lower, like on the East Coast, people were out and about, and it was like clear this was going to be behind us one way or another. Human ingenuity was going to get us through it. And then the question is, what happens with your stay-at-home names, right? So what happens with, I don't think I'm allowed to, this is taped, so I can't mention individual companies. So the exercise bike and the software that we're on today that we're talking on, stuff like that. What happens if you have a different growth rate going forward? Can the stocks perform? In my experience in the world, the answer is no, right? When you have a second derivative change, meaning the rate of increase slows, even if it's still increasing, when the rate of change slows, right, stocks go down. And if they find it hard to perform. So certain companies that were beneficiaries may find that the multiples will not be what they were at the peak last summer. Other companies will earn right through it, right? They will just earn right through it. So I'm thinking your large software cloud companies. I mean, look, this is obviously the future of the US, economy. These are permanent wins, right? Permanent wins. And so therefore, those large cap cash flowing companies, I think are probably fine. And they tend to be a little bit more cyclical anyway. I think here, value and will out earn tech, right? Value will out earn tech in the next 12 months. And that's why we like value and cyclicals here.
Okay. I want to take a macro and a micro view of the U.S. Market. First, on a global basis, what's your thoughts this year on the world outside of the United States from a business standpoint and a stock market standpoint?
Well, that's also a great question, because it's the same issue, right? It's like, is the real economy reflected in the global market? So we think we're in a world of a weaker dollar for a while. Our Fed is very easy. Other central banks are starting to make some noises about changing extraordinary policy because we're coming out of the pandemic. I really like international developed markets here. The rest of the world tends to be levered more towards commodities and manufacturing and more of the value companies. The tech trade is here in the US. France really hasn't created the next great tech company to take over the world. And so actually, because we think these sectors will outperform, we like Europe, we like overseas developed markets. A weaker dollar is a positive for that. So we like overseas markets, developed economies. I mean, the emerging markets are interesting. You know, in India, the India market is hanging in there despite the headlines. The India market has not collapsed, and to me, that says probably it's not going to collapse. You know, it's hanging in there because I think in some ways the lessons of the rest of the world in terms of the markets are like, you're going to get through it. It's terrible. It's a tragedy, but you're going to get through it. Emerging markets, in theory, should be all right with a weaker dollar and the commodity plays. I think you have to be careful, and I think you have to play regionally, because I'm just concerned that some countries may not make it politically through this crisis, and that's a huge risk that you don't have in developed economies. And actually, in the developed economies, we've had a little bit of that when you think about it. So
which countries do you like in particular?
So I think it's safe to go back into China. I mean, it's some people feel politically that there's too much political risk, and I accept that. But I think it's been so smashed down at this point. I think that the Chinese market looks interesting here, and I think Asia looks interesting here. I also think that the reshoring of supply chains and moving out of China is probably good for Vietnam and Singapore. And so that's good. I think Mexico is fine. I like Europe. I think Australia is fine. I would do IFA, you know, the emerging, developed markets ex-USA. That's a good allocation to the developed markets, you know, which, and in Europe is 3 to 4 months behind the US in recovery. And so is the stock market. So that's a nice place to go. European financials, by the way, are doing great.
Very
great.
Good. Banks. Yeah.
Banks. And you know, those indexes in Europe have a lot of banks.
Right. Okay. Coming back to the United States for a second, the government has continued to supply fiscal stimulus to the economy in response, obviously, to COVID. You mentioned that before. What are the implications of all this money being pumped into the system? You know, long-term implications, the short and long-term implications for that.
Well, clearly it was needed in to get through, you know, to be the bridge to the other side. And, you know, in the beginning, if you remember, everybody thought the bridge was 3 months, and it turned out to be 15 months. So, you know, the enormous amount of stimulus that's been pumped in, you know, is necessary. And actually, I've got this chart where I show the US far outspent every other country in terms of percent of GDP to support the economy. And actually, compared to other countries and OECD projections of GDP, the US is the only country where GDP projections are above where they were before COVID. So the US is actually outperforming itself as a result of COVID. I'm just going to leave it there. Okay. Mm-hmm. There's been so much stimulus, the only country. And in part, you know, I think our stock market reflects it. I just want to say one thing. You know, last year, about $600 billion were sent to consumers from stimulus directly, right? Directly, $600 billion. We're actually spending double that in 2021, even as the economy reopens and we get shots into arms. So we're going to have $1.2 trillion sent to, you know, individuals by September, which is an extraordinary amount of money and probably in excess of what is needed. And, you know, you didn't have to have too much of an imagination to say, wow, these vaccines have a 95% efficacy. If we assume maybe 20 to 30% of the country had COVID, maybe they didn't know it, but maybe they had it. And we vaccinate 40 to 50% of the country. Like, it didn't take too much second grade math to realize, you're probably going to get to something like 60 or 70% between vaccination and, you know, some sort of natural infection. You're going to have a drop in cases. Like, it's not that hard. And we have this enormous stimulus still in the pipe, still. So you asked the question, but I just want to put it in context about how much money this is. We're clearly getting inflation. It's clearly inflationary. You know, we needed to stimulate demand when there was no demand to stimulate, when people were locked up and there was nothing to spend on. But because households couldn't spend on services, you know, no vacations, no seeing Aunt Flo, you know, none of that. A lot of it is saved. $2 trillion extra is saved. The savings rate is 15% in the US. The average is about 7.5% to 8%. that's going to get spent. And the question is, does it get spent all at once, creating inflation, or does it trickle out over time? So that's the big question. I do think we have higher inflation. I think ultimately the Fed, in terms of its policy stance, going to have a very, very hard time normalizing policy here. The Fed doesn't like it when the stock market crashes, okay? If you remember Q4 2018, we almost hit 20% down. As you pointed out on our prep call, like 19.6% down. The Fed pays attention to drops in the stock market. They're going to have a very hard time unwinding and tightening. There's so much stimulus here. We've all been drunk on it. We've all been drunk on it. Everything from meme stocks to, 21-year-olds investing their stimulus checks. There's too much money everywhere, and to tighten it is not going to be pretty.
Okay, well, there's a lot to unpack there. You said a lot there. All right, let's start with Ant Flow. As people go out and start, going out to Ant Flow and maybe taking a plane ride or car ride, we're already seeing the prices of oil going up. So inflation, as you said, is starting to drip in. And the question is how fast can that inflation move up? Give me your worst case scenario on that.
Okay, worst case scenario. So, okay, let's just talk about, there's inflation and there's what the Fed does about it. And that's sometimes called the reaction function. So the Fed has said they're doing nothing this year. All inflation reads won't matter because there's too much noise, right? There's just too much noise. Okay, fine. So, I think you're going to have another month-over-month huge increase. Okay, we've seen it in the goods sector. What we learned last month is that the inflation is also in the services sector, right? I mean, if any of you've gone out to eat, your favorite restaurant is 20% higher in price. I mean, that's just it. We have sticker shock. We can't believe what it costs 3-4 people to go out to eat. So there's been increases pricing in the service sector. You need to look at 3 things to see whether this takes hold for longer than just the summer, right? I think the Fed is comfortable with just higher prices into the summer. You would expect the stickiness and kind of friction in the economy as it reopens. So you have to hire people. Maybe demand is more than you thought. You didn't really want to hire people in anticipation because you don't want payroll if you don't have demand. So you probably have the demand first, right? So there's going to be stickiness. That's completely understandable. The CPI report actually was entirely consistent with temporary inflation, by the way. It was used cars, it was airline tickets, it was hotels, it was all the things you'd expect friction in. 3 things you have to watch. Wages, right? A little bit of inflation is great for employees because you get higher wages. So, how heavy are the wage pressures? Okay, Fed's gonna be watching wages. Housing. There's been huge increase in housing prices. And so the Feds, and that tends to be sticky in terms of creating a cycle of inflation. So, how sticky are these higher housing prices? And then finally, inflation expectations. The Fed's very worried about inflation expectations becoming unanchored. They're not worried now. Those are the 3 things the Fed will watch: wages, housing, and inflation expectations. I think we wind up in a permanently higher inflationary world, but not bad, right? So different, but not disastrous.
What's your inflation number this year, next year, going forward?
This year, look, I mean, I think this year you're easily going to get to 3%, and we're already there. I don't think that's a question. So the issue is, what happens here? I think we wind up at 2.4 to 2.6%. That's kind of a healthy place to be. That's not so bad.
That's not bad.
That's not bad. It is good for Main Street. Look, it's great for businesses. They can raise prices. Employees get higher wages. It tends to be a good thing. And actually, it's not bad for the stock market either. There's kind of like a misnomer. Like if you get much higher than 3% for a long time, that would not be good. But I think the market is buying. The market's buying what the Fed is selling, which is higher in the short term, lower in the long term, inverted inflation curve. Market's buying it. So I think we're okay this year. And even the PCE number that came in last week, it was a little hotter. Market yawned, just yawned.
What about GDP growth? What are you looking at for this year, next year?
Oh my gosh, I think we're getting 8% real. something like 11% nominal, right? That's nominal is after inflation. Why does it
How
matter?
long has it been since we've seen those kind of numbers? It's been,
If we get more than 8, it'll be 1952, I think, or the early 1950s. If we get 7 to 8, it's 1982. So
okay.
we are really in an extraordinarily different world. And again, it's like how much, the US is 70% consumption in terms of our economy and GDP. How much of that extra 2 trillion is going to get spent down? And is it slow over time, or is it a bolus? It's really hard to tell. You can't take 4 trips to see and flow at the same time.
But yeah, right. That's true. That's
right?
true. But once you see ant flow, man, you can have a big party. You can right?
And people are
and spend a lot of money.
The other thing about stimulus, which I want to point out, I mean, I said a lot, okay, so all of our restaurants are 20 to 25% more expensive, but we are all inelastic to that, meaning we'd rather go out. We want to go. We're going to spend the money. And how much does that sentiment trickle throughout the entire population? You've got extra money. You've got some stimulus from the government. You've got a job. Worst is over. You are not in the Great Depression. There's some part of the population that is in the Great Depression. Okay. The 8 million people maybe who are no longer in the workforce. We can talk about the labor. So that is a real thing. For everybody else, there was a lot of money. And so if you're willing to pay the prices, that becomes the inflation spiral, right? Because until people say, I'm not paying it, prices go up.
Right. I mean, you go into, you've got a great point with the restaurant. You want to go out, you want to have fun, you're paying those prices. But I guess the question is, next year at this time, you've been paying those prices, and it's like, do I really want to go out and spend all that money? Maybe I'll cook at home or do something else. So
that's right. No, it's a real question, and so that is sort of like, do you have too much stimulus and then a fiscal cliff at the end of it? We can talk about that too. But I'm very positive about this year. I'm pretty positive about next year too. I think it gets trickier in that 2023, 2024 area because we've all enjoyed it. We've all enjoyed the market. We've enjoyed the money. We've enjoyed the easy policy, and a bunch of things will be happening all at the same time to tighten that. So it'll be a little trickier.
Okay. Well, we just talked about one of the curse words of investing, which was inflation. I want to talk about the other curse word, which is taxes, right? So there are proposals for higher taxes. How will this influence the markets? How will this influence individuals? Of course, we don't know what's going to go through, so it's just really speculation, but I just wanted to get your thoughts at this point.
So I think maybe what I'll refer to is what the administration has proposed, because that's something I think we've all probably read. And yeah, again, we don't know how this is going to get negotiated down, either if it's bipartisan with the Republicans or within the Democrats, because apparently the farm state Democrats are having a tough time with that estate tax, which it will be close to 60 or 70%. It was snuck in like, oh, we're not changing it. Well, they are changing this because they're changing the step up basis. What really matters to markets? I think the corporate tax rate and I think the capital gains tax, right? Those are the things. I mean, clearly, I think that's a no-brainer. Get used to it. The individual tax rate's going up. The only question is SALT going to be reinstated? I'm sitting in New York City. I am from Great Neck, as you know, Mark. So clearly, we all care about SALT because all of our taxes went up with the 2017 tax plan. So there is a demand from the blue states, the coastal states, the high tax states to reinstate SALT. I don't know if that deal is going to get done. What I do know is that the top rate is going up. That tends not to affect the market. Okay, it's not going to affect the market. The corporate tax rate could, okay, as proposed, and it's already getting whittled down. As proposed, if it's implemented, you have to shave 8% off of earnings in 2022. Okay, it's just going to take 8% off of earnings. It's like
and whittled down to what, 20? You're looking at 25% or 28%, or what do you? As
proposed, it's 28%, including what's often not talked. That's the statutory rate, but then there's the overseas rate called the GILTI and the SHIELD tax. That's actually the nefarious tax. That's actually where you really tax multinational companies a lot. In fact, you tax tech and healthcare the most. In fact, you tax semis and biotech the most. I will just let everybody think about the irony of sort of the tech and biotech companies getting us out of the pandemics, and then they're going to have a huge tax on their businesses. So that will shave earnings if enacted, but you need the international community to go along with that international tax, so we don't get, Ireland's at 12.5%. They're like, thank you very much. We're going to keep our 12.5% corporate tax rate. It works for us. So as you know, there were distortions of policy as a result, because US corporates chose to put their domicile in Ireland, in Dublin. You need international agreement. At the G7, Janet Yellen, our Treasury Secretary, is trying to work out an overseas rate. The administration proposed 21%. Now they've moved down, the administration has moved down to 15%. It looks like the French might be more amenable to that, but you need every OECD nation to agree to this. That is 40 countries. I don't know. Someone's going to cheat. It's a free rider problem. It's going to be in one country's interest not to do this. And once there's an opening, I don't know if that overseas tax is going to go through. My best estimate, 25% on the statutory rate. Even Joe Manchin supports it, so the Democrats can get this through reconciliation. Overseas tax, we're at 15%, maybe gets whittled down to 13% to get all the OECD countries, a lot better than 21%. And then your 8% shaving of taxes goes down to about 5 or 6% on the S&P earnings, right? On the 2022 earnings. So that would affect the market. Capital gains, obviously, at 43% is not really economically wise. You collect less money. You raise the taxes and you collect less money. Why? Because people don't do realizations. People don't sell. They don't sell. They just pass it on. And every study has shown this. So I don't think we're going to be at a 43% capital gains tax. It's really counterproductive. I think we will wind up at 28%, but you have to add that 3.6% Obama care tax on top. So even though they're going to call it 28%, it's really 31.6% on your long-term capital gains. So it's not that much different than the regular rate in the end.
Right. Okay. Well,
that's not great. That's not great.
That's not great. So you think that'll negatively affect the stock market? Well, might not, because we're getting so much growth.
I think in the short term, there's so much stimulus that it's going to outweigh the taxes. But in the longer term, this is what I mean by the fiscal cliff. Like, we've had so much money coming at the US economy, and then it starts to trickle off. And let's say we increase taxes, in 2022. Well, those tax increases happen immediately, right? So that represents a tightening. And even if the Democrats pass a $2 trillion infrastructure bill, which they could, and that seems like it would outweigh the taxes of 1.5 trillion, apples to apples. The truth is that money doesn't start getting spent till 2024.
Right.
Actually, we have a podcast on this. And I've talked to, we've talked about what infrastructure spend means. And even if the bill gets passed, and even if the money is allocated for 2022, 200 billion a year for 10 years, let's call it, just as an example, even if it's allocated 200 billion in 2022, 200 billion in 2023, it doesn't actually get spent. It's allocated, right? So it's sort of, it's in the liabilities column, but not spent. Meaning the economy is going to feel the taxes first, and that's your fiscal cliff, right? Because your taxes happen right away. The spending doesn't happen until 2024. So you're going to not pump the money in as fast. You're going to raise taxes. The Fed is going to be tightening. Is that so great? That's why I'm a little nervous. I'm a little nervous about the timing of all of this.
I also talked about the long-term capital gains being retro to April, I think 20 something, April 28th. So that means you can't take advantage of that. But I've read that, but I've also read some analysts say that that's not going to happen. That doesn't really happen. If you look at the last bunch of increases that didn't happen, they gave you a date far in the future. What's your thought? Do you think it'll be retro, or do you think it'll be in the future?
I don't know if it's legal, actually. There may be legal challenges to make it retroactive because companies, may have done acquisitions or may have done like, different capital strategies based on the old law.
Mhm.
And it may be actually, if I were company X, I'd be suing, if they made this retroactive, because you can't actually function. What's great about our economy versus others is that, we have rule of law and we have property rights and we have rule of law. And if the law changes and you've conducted business under what was a different regime, but you didn't know it, that doesn't feel legal to me. As you pointed out, we've only had 4 capital gains increases in the last, let's call it whatever, 60, 70 years. None of them were retroactive for that reason. There's a political agenda here really to kind of make sure people don't get the fruits of, their capital before it's taxed. So that's why that's happened. I think there'll be legal challenges. The thought was that the capital gains changes would not happen until the bill was signed. That was the base case scenario. The market is not reacting to it because I don't think it thinks it's going to happen.
Okay. Well, I'm going to take a pause here for a second, talk to everybody that's out there. If you'd like to ask Alicia a question, if you go to the bottom of the Zoom, there's a Q&A button. You can hit that button and you can type in a question for Alicia. I have a lot of questions for her, so don't worry if you don't have any questions. But while we're taking this break, I am going to talk a little bit about Star Wars and Mandalorian. So Alicia and I, off camera, have talked about Mandalorian. For those that are going to watch, or for those of you who haven't watched the end of the 2nd season, I'm just going to mention a spoiler alert. You might want to go on mute just for a little bit, but we're going to talk about, and for those of you who don't know what The Mandalorian is, it's on Disney Plus, and it's a show on there. It's a terrific show. My son turned me on to it. I think Alicia's son turned her on to it, and she watched it with her son, and it's just a terrific show. And who's your favorite character on there? Alicia?
I'm kind of touched by the Mandalorian, sort of, hardcore exterior, but like a cactus, but soft on the inside. So his transition, I think, is really fun. And of course, Grogu is just like, Baby Yoda. I still will call him Baby Yoda. He's just too cute. We have Baby Yoda Legos everywhere, all sizes, everywhere. We
actually do also from when my son was younger. We didn't throw it out. We still had, and he has all kinds of action figures and all that other stuff. And spoiler alert here, Boba Fett showed up. Boba Fett being a Mandalorian.
Yes.
And I was talking to my son this weekend, and he said that when he saw the ship come in, he knew exactly that it was, he was going crazy. He goes, "Oh my God, Boba Fett."
They go crazy. Well, it's so funny you say that because I have 3 sons. In case any of you have seen me on TV, I have a picture of my 3 sons, and we're a Star Wars family. My son, who's now 14, had a lightsaber in his hand when he was 1. And I turned to my husband. I'm like, that's the end of me. I'm done. That's it. There's 3 of them. But somebody built a Boba Fett ship. That ship that you're talking about with like the little short wings, and it looks like, and to me, it looked like a cockroach. And it's sitting in my living room. So I said, get that thing out of my living room. It looks like a cockroach. And then when I saw The Mandalorian, I'm like, okay, it can stay. It can stay in the living room. Now I fully understand. But very excited at Boba Fett. I didn't quite understand it.
Yeah, that was very cool. Okay, I don't want to do any more here for those of you that don't that haven't watched it yet. Excellent show. All right, coming back. Where do you see gold in the use in portfolio construction? Where do you see gold?
So I'm actually very positive on gold. I think that the excitement over Bitcoin probably took some of the some of the investors who would naturally turn to gold over the last 6 months probably turned to Bitcoin, probably going to go back to gold. I see it as a hedge. I see it as an inflation hedge. I really wouldn't do more than call it 3 to 5% of your portfolio. But technically the chart looks great. It's been outperforming Bitcoin actually for 3 months. I mean, obviously in the last few weeks, Bitcoin's been cut in half, but it's been for the last 3 months. It's got one of those nice technical charts. It works in inflationary times. It works in uncertain times. It works during loose monetary policy. I'd say 3 to 5%. I'm very positive on gold here. I think it's actually a good time to buy it.
Okay. And what's your thoughts on Bitcoin?
Bitcoin. I love the fact,
or digital currency, I should say, not just Bitcoin.
So, okay. The thing about digital currency is, again, we're going there, right? Mm-hmm. We're going there. And the question is, what's the market clearing price for that? And for those of you who remember .com boom, I mean, this is a funny thing to say because it sounds like so basic and stupid, but like the internet is still here, but not all those companies were worth that price. Right. And what the market got right in the late 90s is that we were in the midst of a digital revolution in payments and communication and connectivity and research and how we worked. That was all correct. That was right. The issue was, were those companies worth what investors were paying? So I want you to now pull forward, 20 years. We're sitting here. It's clear we're going to have a digital currency. The Fed is talking about, like a stable coin for the US. The Treasury, I actually don't know if they can regulate it. They will do their best to regulate it. I like the fact that there's no intermediary with Bitcoin, right? Like, so that's the thing. It's not PayPal, it's not Venmo. There's the intermediary. There's your bank, there's your credit card. Bitcoin, there is not. And so that's the excitement over it. That's why banks will try to regulate, the central banks will try to regulate it. Can I tell you what the market clearing price is? No. I will say the chart looks awful. The chart really looks terrible. And, just keep in mind, like when things go up in a parabola, so they go straight up, right? Think of your 11th grade math, you got a line all the way up and they start to roll over. Mm-hmm. You can lose 70% of the price with stocks or just asset prices in a rapid rise. And I think Bitcoin is at risk here for that. Now, I believe in the digital currency. I believe in that revolution. I can't tell you what the clearing price is for it. And I know that's really frustrating and annoying. But if you think of it that way, don't put half your money in it. Again, this is all about, allocating a risk across the board. And to the extent that investors thought that Bitcoin was negatively correlated to equities, not really, right? It's not going to be like a non-correlated asset. It's going to be correlated to your speculation and your speculative techniques.
Okay. Well, thank you. Thank you for that. So if I can understand what you're saying is that you're equating this to kind of the beginning of .com area where pets.com got a valuation of 100 times revenue and went out of business, and all these .com companies going out of business. Cryptocurrency, there will be a winner, just like internet. There were plenty of winners, and internet's here forever. Cryptocurrency will be here forever. We don't know if Bitcoin is the winner, if Doge, or some of these other Ethereum, all these other names are going to be the winner. The winner might not be alive right now, right? I mean, it might not be, we don't know yet. It's very, very early there, and it's quite speculative. So you just got to be, and you can make a lot of money too, but you just got to be very, very careful dipping your toe into this. And like everything else, you need diversification.
Right. And I'd say this, like, know what game you're playing, right? I mean, look, there were moments this year where like people said, I'm just going to play it because it's fun. And that's okay. But know that you're playing. It's not investing. And it's not a long-term capital allocation, right? It's a different thing that you're doing if you're doing it. I don't see Bitcoin price here as particularly in other words, better here than where it was at 62,000 after the parabola. But I think there's risk to 20,000. I do think that. Will it go there? Again, hard to time the market, but there's
Right.
risk. There's risk.
Okay. Well, I want to talk about commodities for a second. Commodities has been in a bear market for 10 years. Goldman Sachs commodity index over the last 10 years has gone from 36 down to 9. That's a negative 13% per year return, near the opposite of what equities has done during the same period of time. Do you think now there's a regression to the mean that commodity pricing will start to do better than the equity markets?
Yes, and I actually, yeah, the short answer is like yes. Having said that, prices have moved quickly. I would expect some consolidation here in some of the more obvious places like steel and copper. Clearly, we see it in lumber prices. But if you think about, what's happening is that there's massive demand and massive supply shocks. And so there's massive demand to restock inventories, right? There are no inventories anywhere. Because it's kind of like what happened with labor. You're not going to hire and you're not going to build inventory until you know where demand is. Well, now we know where demand is and it's red hot. Okay. So that's pulling on commodity prices. The other thing that's pulling is the futures prices. People like us, like in a sense, we do derivative stuff. We're not building businesses. Well, some of you might be in the real economy, but we're buying assets that are, levered to the real economy. So it's a derivative play. And so to the extent that you buy commodities to hedge inflation, you're part of the inflation. And so we all are. And so for that reason, I just think that commodities are moving higher. If you think about the movement to the green economy, right? And from the internal combustion engine, from grandpa's economy to your grandkids' economy, right? If you think about sort of the span of 5 generations of what's going to happen, what's going to power, it turns out that an electric vehicle needs 4 times as much copper as an internal combustion engine vehicle. It turns out that, per megawatt hour, a wind farm needs 5 times as much copper as a traditional power plant for the same megawatt hour. So to get to the green economy, you need like a lot of dirty metals, and you need oil, and you need a lot of these commodities, and that transition will be very positive for that sector. I think we're in for multi-year here. Again, prices move quickly, got to be careful. I don't like parabolas, but I think that ultimately the demand is there.
Okay, excellent. Well, I have a lightning round. You ready for a lightning round?
I hope so.
Okay, here we go.
Where's Jim Cramer?
Yeah. Okay, here we go. Ready? U.S. markets or international markets?
International in the short term, U.S. long term.
Okay. The Dow, higher or lower by the end of the year?
Higher.
Okay. Over or under 3% inflation this year?
Over.
Okay. Well, I had this gold to Bitcoin. I know that. Okay. U.S. dollar from now to the end of the year, up or down?
Down.
Down. Okay. Small cap or large cap?
Small caps have been dogs, but they're not done yet. Small cap.
Small cap. Okay.
I'm playing reflation, high growth. Small cap.
I know the answer to this, but value or growth?
Value.
Okay.
But.
Ooh, there's a but.
Growth.
I like the but.
You have to be diversified. You need growth.
Yes.
Value.
Yeah, you don't put the whole thing in. I get it. You want to have diversification. Excellent answer. Over or under $1 trillion more federal help this year?
Over. Oh. I mean, that's
over under $2 trillion.
Over. I think it's going to be all reconciliation.
Over under $3 trillion.
It's about right. I think that it's going to be all reconciliation.
Okay.
Meeting Democrats only. Meeting Democrats only, which means they proposed 4, so I think 3 is the right number.
Okay, I got 3 more. Star Wars or Star Trek?
Star Trek.
Star Trek, you're a Trekkie.
I'm a Trekkie.
Oh my God.
I'm a Trekkie.
I was almost positive that you were going to say Star Wars.
No, I'm a Trekkie. I'm a Trekkie. I love Star Trek.
Wow, that's amazing. Okay.
I'm the universal translator. Yes.
By the way, one other thing about Mandalorian, and I hope I can say this, we got a mixed crowd. The women on the Mandalorian are badasses. Hope you don't mind me saying that.
No, I love her. I love her. She's got
Oh.
arms so big. They're great.
And there's a few others also. Some of the
Yeah.
other Mandalorian women. Oh, badasses. Okay, sorry.
Yeah.
Getting back. Okay. Favorite ice cream?
Okay. Haagen-Dazs vanilla Swiss almond. It got me through the pandemic. That's it.
Okay. I'm almost going to drop the mic on that one. All right. Last question. Favorite movie?
Oh, favorite movie.
I should have dropped the mic. All
Yeah,
right.
drop. Yeah,
Back to Haagen-Dazs.
I don't watch movies anymore. I'm busy watching like Netflix and Amazon. We stop with the movies. They're not as good as the TV, to tell you the truth. Yeah.
So is that a sign? Is that a sign for the future? Would you short the oh, you can't say that, but movie theaters no more, good popcorn?
I think it's going to be hard to get to capacity that used to be. I think that the capacity is over. I think it's over. Yeah.
Okay. Well,
I mean, there's certain movies that my teenage children will flock to the theaters to see. I don't know if people 40 and over are ever going to a movie again. I mean, I don't know,
Okay. Interesting. All right.
Yeah.
Well, Alicia Levine, you've said it all. And we really appreciate you coming on Coffee with Krav. Well, we'll get you a coffee, one of a kind coffee with Krav mug. Yes, we'll get you one. I just want to remind everybody that Coffee with Krav is the first Tuesday of the month at 10 o'clock. Next month, it is going to be July 6th, right after the July 4th weekend. We have a supermodel, Emily Sandberg Gold, also CEO of a company. I think that you'll all enjoy it. So please join us next time. Same bat channel, same bat time, Coffee with Krav. Thanks, everyone. Thank you,
Thanks,
Alicia.
everyone. Thank you. Thanks for having me, Mark.
Welcome.